Hi, my name is Jim Henheffer. I'm a licensed mortgage advisor with Qantas Mortgage Solutions here in Calgary, Alberta. I'm also a licensed real estate agent with CIR Realty, and I'm here to talk about a few things. And I'm really happy that the Integrated Advisory Network invited me in to share a few tidbits and some knowledge that I might be able to provide in my space of work. I'm going to go through a few things today that I think might be helpful. I'm going to provide some framework and explain a little bit of what goes into buying your first home. I deal with first-time home buyers quite frequently, both on the mortgage side and also when buying their first home. I think it's a really fun market, or part of the market, to deal in. I get to deal with all sorts of people and all sorts of age groups, and it's important. I take that role pretty seriously because it's the beginning of a person's journey into owning a home. Generally speaking, when people come to me and they're looking to buy their first home, the first step is to get the mortgage pre-approved. A lot of times people will go into their bank or their mortgage broker, and this process is done kind of behind the scenes. I like to approach it a little bit differently. I think it's important when I pre-approve my clients that they have a basic understanding of what I'm actually looking at when I pre-approve them, because I think that it's important not only to know how the lender sees you or how the bank, what they think your qualifications are, but I think it's important to relate that to maybe what your overall goal or what their overall goals are with regards to budgeting and financial planning. I try to tell people when I'm pre-approving them for a mortgage, basically a bank is going to look at your financial well-being at a certain point in time. Of course, they're going to take a look at your credit to ensure that you are in a position that a bank is going to want to take you on. They're going to look at your credit history to make sure that you do have some credit, that you're using it wisely, that you're not showing a whole lot of late payments or missed payments or just general credit worthiness. They're also going to take a look at your current net worth, what you own for assets, what you have, what you've gathered over the years, what you have for fallback. But most importantly, in this day and age, the primary driver for mortgage lending is debt servicing. Simply what that means is, do you have steady, regular monthly income? Can you prove it? And if that is the case, generally speaking, they will simply lend you a specific ratio of your monthly income they will allow to go towards your mortgage principal and interest payment, your heat, your property taxes, and any other credit payments you have, credit cards, car loans, student loans, etc. If the application itself has $10,000 of gross income a month, a bank will lend you up to $4,400 of that to go towards all of those items that I said. And that is basically how I come up with, and how a bank would come up with, how much you can qualify to purchase. So if you have $10,000 in monthly income, I might start with a $500,000 house with 5% down, and I'll make the calculation for that principal and interest payment based on what you'll be looking at for a contract rate. In Canada now, for the last 10 years or so, they've required us to build in a little bit of they call it the stress test. I'm sure most people have heard of that. It's basically a 2% buffer that we have to add to that contract rate, just to allow for some variability in interest rates over the span of owning your home, because a bank wants to know that you're able to absorb any kind of increases in mortgage rates, which actually became pretty important over the last few years as we saw a pretty good jump in rates. So when I calculate that principal and interest payment, I'll add it to your car payments, we'll add it to the property taxes for the home and the heat, and all of those items will add up, and I will find out what is 44% of what your gross monthly income is. And that's it. That's how a pre-approval is done. I find it's very, very important to to be a little bit more thorough in a pre-approval as opposed to just doing a quick pre-qualification, especially in this market because it's competitive, and you want to make sure that first-time home buyers are prepared and in a position where they're ready to make that jump when the right house comes along. Specifically, talking about down payments for first-time home buyers, there are a few programs in Canada that are tailored towards first-time home buyers, specifically in terms of their down payment. There's two programs right now that are used pretty frequently. The one program that's been around for years is the RRSP First-Time Home Buyers Program. That's the program that most people are familiar with because it's very effective, and there's a reason it's the one that has been around for a long time. Essentially, what this program allows for you to do is you're allowed to draw money from your RRSP for the purpose of your down payment, or realistically, it's not even for your down payment. You can pull money from your RRSP as long as it's going towards the purchase of your new home. What that means is if you have $25,000 sitting in RRSP, you can pull that money out to use for your down payment, and you're allowed to pull that out without incurring taxes or without having taxes withheld for that withdrawal. This is great because basically you can use that money for your down payment, and what they expect for you to do is after a 2-year grace period, they expect you to pay yourself back that $25,000. For most people, that's not a real difficult ask because the expectation is that you're probably going to keep on earning more money, and you're probably going to invest more into your RRSP as you go. That's the intention of the program. It's a great one because a lot of times, first-time home buyers have been working for 5 years before they buy their first home, and there's a lot of companies that might have programs set up that are automatically deducting money from your check and putting it into an RRSP. Maybe they're matching. It just happens to be a vehicle that a lot of people have funds locked into that could be used for their down payment. So the ability to grab that money has been a really, really useful tool for first-time home buyers. I actually like to use it for even if first-time home buyers are getting gifted funds, maybe from a direct family member, from a parent, for their first-time purchase, or if they just have money sitting that they've saved over time. I think it's a really valuable tool, even if they're planning on buying a home, to take all of that money that they've received or that they've saved and sink it into their RRSP so that they can utilize that program. That money has to sit in the RRSP for 90 days before it's usable, but the benefits are pretty great. I mean, if you put $20,000 into your RRSP to use for your down payment, depending on where you land in the in tax bracket, you're going to get a pretty significant tax refund that year. So it's worth doing. So that's by far been the most popular program. There is another program that came in 2022. It's called the First Home Savings Account. It's a very similar program to the First Time Home Buyers RRSP program. The difference is with this program, you actually set up a savings account that you can start setting aside money for the purchase of your first home, and that money put into that savings account is tax-free. So as opposed to the RRSP program where you are essentially delaying the tax you're going to pay on the money you put in your RRSP, this money that you put into the savings account is not taxed. So this is probably even more valuable program. It's designed to be used over time, to be saved over time. You can only put $8,000 a year into that account that you get that tax benefit on, and to a maximum of $40,000. So essentially the plan is, hey, let's start saving for your down payment over a span of 5 years. So really, really great program, especially if you do have a longer outlook on when you want to buy your first home. Maybe not as useful as the RRSP program if you're looking to buy very, very quickly and you want to get the the benefits of a bigger chunk of money quickly. The RRSP program allows you to pull out up to $60,000 now. That's gone up, a handful of times over the last few years, which makes sense because, 10 years ago, $20,000 out of your RSP was a 5% down payment on most properties, and with property values skyrocketing, without having a better term for it over the last few years, moving that to $60,000 is much more realistic with regards to how much money someone needs to pull out to make that down payment. So that's the first home savings account. Great program. Probably has a net better benefit from a tax perspective than the RSP program. It's newer. It's only been around for a few years. Hasn't been communicated really well to I don't think to clients or originators like myself. So there's a little bit of work to do there to make sure that that we know how to use it, how to set up that account and everything so that it can be so it can really be put to work. A lot of times first-time home buyers are coming to me and they're actually meeting with me with their parents, sometimes their grandparents, and a lot of times I'm getting asked, how, as a parent or as a grandparent or a family member, how can I help my child become better prepared to buy their first home, or how can I, in a lot of cases, how can I financially help them out? And realistically, there's a couple different ways that I primarily see. One of the ways that's actually quite common is often a parent or a family member will need to come on with a first-time home buyer as a cosigner. That just means that usually a parent or grandparent has a little bit longer credit history. They might have more income to bring to the application that will help if someone that's buying their first home maybe hasn't been in their job long enough, or maybe some of the income that they're earning isn't verifiable. Quite often a parent will come on as a cosigner, which in Alberta requires actually the cosigner to be on title and mortgage. But more commonly, I see parents and grandparents come on the scene trying to help out with the down payment for the purchase of a first home. And with regards to how that works is that those funds need to be provided as a gift. It's really important that it's understood that those funds are being provided as a gift to the first-time home buyer and not as a loan, not as a short-term loan, not as something that's going to get paid back when the house is sold. It is gifted funds. Now, with regards to the first-time home buyers programs that I outlined, these gifted funds or this help from a family member can work very well with both of these programs. I would say that if you are a parent that's trying to help your child save for a down payment, and you know that the horizon's a little bit longer, it's likely going to be a few years until they're in a position to buy their first home, I would say the first home savings account that came into effect in 2022 would be the best vehicle to utilize if that is the case, because you could give the funds to your child in increments over the years. So you could provide $8,000 every calendar year that they could put into that first home savings account, thereby reaping the benefits of that $8,000 tax-free account. That would be the best way to. I think that provides the most financial benefit to the first-time home buyer. However, in a lot of cases, people do not have a 5-year time horizon of buying that home, and if the money is going to be provided on a bigger scale in a shorter amount of time, then it would make more sense to utilize the RRSP program, because essentially you can sink $60,000 into that RRSP on January 1st, and 90 days later that money can all be pulled out and is usable for the down payment. After it vests for 90 days, it's usable. So it's a much more time-friendly vehicle than the first home savings account. But as far as I know, there's actually no real rule against utilizing both. So, you know, if you're in a position and you have money, it probably makes sense, even if you know that your child is going to buy that first home within the next year, it would make sense to utilize at least that $8,000 room that you have in a first home savings account, and then put the rest, you know, have them put the rest into the RSP so they can reap the tax benefits of both. That's usually the framework for the conversation that I have with first-time home buyers. Like I said, I think it's really important to give people more information maybe than they might get if they go and talk with someone in the bank or someone or someone that's not, you know, in the day-to-day mortgage business. And unfortunately, that's a lot of times the people that are providing these pre-qualifications. You know, they're done with a quick sheet, and I just think that there's a lot of value for myself as a professional to prepare my clients a little bit better, so that they don't just get a number spit out to them that says, hey, this is what we will lend you. Go find a house that, you know, is worth this much money. It's important for them to know that this is why, this is the amount of money that the bank will lend you, and then talk to them about, does this align well with what you have budgeted from a monthly standpoint for what you want to buy? Because that's not always the case. If a bank will lend you $500,000, but when you do your budget and you start incorporating your lifestyle and your recreation activities, your vacations, you know, what it costs for food, you may find out that just because the bank will lend you $500,000, you may only be comfortable with $400,000. And that's an important conversation to have. That's a conversation that I have. I just want to thank Integrated Advisory Network for having me in today. I really appreciate the opportunity, and I hope that I provided a little bit of information for everyone. Thank you.